For more on this, we're joined by Eser Ozdil. He's a non-resident fellow at the Atlantic Council. Welcome to the programme. Now, oil prices are stabilising as reports suggest that the US and Iran are close to reaching a deal, but prices are still very much volatile. Are markets over-optimistic at this point?
Market is optimistic at this point because of a potential ceasefire. However, I must say that still there is a divergence between financial and physical markets. Even though in the financial markets, Brent prices are around $95 per barrel, if you go to the physical markets, you can see the different prices between 130, 150 US dollars. So until end of a war, we will continue to see this divergence because of the flow disruptions in different regions of the world. However, still the ongoing peace talks are very much positive signal for the market.
Right. Meanwhile, the US's crude shipments surged close to a record high for the first time since World War II last week to meet demand from Asian and European buyers that's scrambling to replace Middle East supplies cut by the Iran war. Do you think that's sufficient to offset the current gap in supply?
Not at all, because the Hormuz Strait was the home of passage almost 20 million barrels before the war in daily basis. And thanks to East-West pipeline, which is bringing Saudi crude from the east of the country to the west, working around 7 million barrels a day. And we have seen cut of 2.5 or 3 million barrels because of the demand disruption. And also other Gulf countries are sending 3 to 4 million barrels a day via alternative sources. So basically, the physical gap is around 45 million barrels, and US only can subsidize 1.5 million barrels a day. So still we are talking about 3.5 million barrels a day gap between supply and demand globally. So as I said, that the US supplies are just as short-term relief, but however, the gap is over there in the market.
And with the Hormuz blockade still very much in place, even if a deal is reached, how long until supply is back to normal?
It will take a couple of months to see the normal flows in the market. However, we consider that the prices will be still sticked above of the pre-war situation, because before the war we have been seeing the prices for around $60 to $65 per barrel. And based on my calculations, even though if we see the peace, the flow will not be 100% secured, considering the pre-war situation. So that's why the prices will still be around $75 to $80 if we see a full peace talks gives final decisions. However, in the natural gas market, still the market is going to be much more tighter than the pre-war situation because of the attacks to do Qatari trains. And the official declarations of the Qataris are saying that some of the trains will be online not less than for 5 years, basically. And this is going to be a rate almost 20% of the Qataris liquefaction capacity, considering the pre-war situation. So still a couple of years we will see tight natural gas markets because of supply shortages in the LNG side.
And are we starting to see signs of a loss of demand in key economies, or do you think it's still too early to tell?
The demand loss is because of the supply shortages. If the supplies are increased based on the pre-war situation, we can see the higher demand. However, we can see permanent demand shortages if the oil prices goes above $120 and $130 in the financial market. So demand loss is in the market, yes, but it is because of the flow disruptions.
We'll leave it there for now. Eser Ozdil from the Atlantic Council, thank you very much for your insights.
Thank you very much for having me.